In the game of loans, you either win or you learn. Welcome to the game of loans, where fortunes are forged and empires are built. Your hosts, lords of lending and wholesaling, are here to guide you through the realm of real estate and wealth building. Brace yourselves, cash flow is coming. You know, I got to be honest, sometimes it drives me nuts when I speak to people. For instance, I spoke to our mutual friend, Brandon, right? He was calling me yesterday, and he sold his business, the Airbnb business, and he's like, what kind of investments can we do together? This is my conversation with him yesterday, where I could get some yield. So I told him, I said, look, when we're lending on a deal, a lot of these real estate guys, and a lot of people don't know this, or some do that are in the real estate business, I said the more active the real estate investor is, the less money he's got. It is what it is, right? It just has nothing to do with him. He's got the assets, but he's not liquid, right? So I said, you could come in on that 15%, and you could earn anywhere between 13, 14, 15, 16, up to 18, 19, 20% on your money, right? And he's like, well, what are the risks? I said, well, I have more risk. I'm taking fucking 85%, right, of the risk, because I'm lending out of a $100,000 loan. I'm coming in with $85,000 fucking dollars that we're lending, and you're gonna have to come in for that 15%. He goes, well, why is it that I can earn so much more than you can? I said, you're going on the equity side, and it's just different. I'm in first position. So I explained this to him, and I said that the money's going to come back, and his reaction to me was, well, I'd rather be on your side. How can you just, I'm sitting on all this money. I'd rather take no risk and make less. And I'm thinking to myself, like, you're fucking out of your mind. I'd rather be sitting on your side, and if I'm putting up that 15% and I'm making 20% returns in 4 months, 5 months, 6 months, I mean, those are fucking 40%, 35-40% on your money.
You do 2 to 3 of those and you got your money back.
That's
already.
what I'm saying.
Yeah.
But to me, it's like people are so risk adverse, right? And I'm, and this is a guy, he's got money. Yeah. And it's not like, it's a guy, obviously, I'm not telling someone who's got $100,000 to their fucking name, right, to go in and put up that $100,000. Although I'm fucking psychotic, I would do it myself, right? I'm fucking out of my mind. But what I'm telling him to do is, he's sitting off, like, say, $5-6 million. Fucking take $1 million and do this. Like you said, you're gonna make that shit up. You'll make fucking $1 million back in a year, right?
I always look at people who are risk adverse is that they just don't understand the risk and how to mitigate it. Every investment you get into has risk,
right?
But how do you mitigate that risk? So being on the equity side in a joint venture structure, you can structure the deal where if they don't perform, you take ownership of that project, right, and you have your own builder or somebody that you can bring in, and then you get 100% of the upside on that. You cut the investor out that failed, that you financed. It's a simple way to get around that. So how do I protect, against principal losses? Well, where is that going to happen? If we have a black swan event like the pandemic or something that occurs where market, prices crash, everybody's screwed. Doesn't matter where your money's at in the stock market and real estate. You're going to take a bath on that, outside of sitting in cash, or treasuries. So I like to just isolate that type of risk because it's risk that's going to affect all parts of the market. Okay, you got execution risk. Well, we're not going to go put your equity into a project without somebody who's proven they can do this. And 99% of the time, if we're going to invest equity in a deal, it's somebody that we've done a deal with before, so we already have a track record with that person. We know them. We're not just going and taking Joe off the street, who's a general contractor doing his first fix and flip and giving him 100% financing and hoping he does a good job. There's enough investors out there that are high quality, A credit, that just have more deals than they have money to work on, but they have the resources and and the team to go out and execute on it. Like that's where you put your money,
So let's play devil's advocate. I told him everything you said. So he came back to me. He goes, well, he's not putting up $1. What's his risk? So I said to him, his risk is, bottom line, his risk is he's going to lose this deal. He is putting up some money because he's the one that's going to have to cover the initial money for the for the rehab funds.
Well, that, and he's got to personally guarantee the loan.
And I said, and he's got to PG it.
Yeah.
So I agree with you. I just think, two things bother me. I speak to the guys that aren't risk adverse, right? That have balls the size of the fucking Empire State Building, and their answer is, 18-20% doesn't fucking tickle my balls, right? But, and then I speak to the fucking guys that are risk adverse, and their initial reaction, this shit is too fucking risky. I'm like, you guys are fucking, both sets are nuts. It's like, it's so difficult to find the ones that have a fucking brain to understand, on the other side, I'm speaking to my other friend, and I'm like, bro, Bobby, let's fucking roll. And he's like, well, my money is in stocks. I'm making 60-70% on my money. I'm like, yeah, also, 2 years ago, you were looking at me fucking crying because you had all your balls up.
Yeah. You could lose 60 to 70%.
Right, that's what I'm saying. Like this.
Yeah.
It's like, it's to find that investor that understands the game that we're playing. That's just difficult. It's so fucking frustrating to me when I get people like this. So let's talk about Brandon, for instance. He's saying, you know what? I want to come in. I want zero risk.
Okay.
And I want to be in first position. How would you structure a deal? And I'm talking to the guys out there, whoever's going to watch this. If these, whoever is listening to this part, some want to put their balls up and some want to be like Brandon, they don't. All right? How would you say to that guy, to a Brandon, hey, come in, I'm going to make sure you have the least amount of risk, where you can make and what is that return? What do you think is fair for a return for Brandon in a situation like this?
Yeah, look, nothing comes without risk. Even lending in first lien position, there's still risk.
Yes.
We take risk lending that money out day in, day out. Being in second or in an equity position is even more riskier, but generates a higher return. So going back to my conversation earlier about financing loans, the bank typically provides a line of credit that gives you a percentage of the first lien note. Right. So, for example, like a typical credit line from a bank is going to finance 80 to 90% of the note, and then the lender, like us in this case, would put in the 10 to 20%, which would be kind of an A-B structure.
Right.
They would be in the A, position. We're in the B. The bank, let's just say the note, for example, is 10%. The bank might get 8% on the 80%, that they put up. They're not getting the full 10% note rate. So we would make a 2% spread on the 80% plus 10% on the 20%. So we would get what's called a leverage return.
Right.
So our return in that case, if my math's right, it's about 18%.
Correct.
On that, our B piece there.
Right.
And then the equity guy comes in, and he's typically doing like either a preferred equity structure where they're getting 12 to 24%, or it's a profit share structure where you carry the risk. Your risk is, the margin on the deal, and if they can actually get the project done for the cost that they think to and sell it, at the price point that they're going to sell it. Those are generally returns in the 50 to 100% range, but carry a lot more risk because you're not getting a guaranteed rate there. Depending on your investment size, the A-B note structure is hard to manage on a single loan basis. If you really want that, just go buy bonds against mortgages. That's effectively what it is. A securitization package is, pool of loans, and they sell them in different risk tranches. So you have your AAA, AA, single A, triple B, double B, single B, risk profiles. And each one of those tranches of the securitization is a different percentage of exposure to the overall pool of mortgages. And that's a way that like big financial institutions, so like your insurance companies and guys that have very low appetite for risk, they'll go buy the AAA portion of the bond, which is like 30 to 50%, of the 70-80% note, or loan to value. So their effective like exposure is like 30 to 40% of the property value. They're never going to lose that. I mean, if they do, we're all,
fucked.
Everybody's screwed. But they're going to get like 2-3% interest on their money because they're in the least risky position. So, and then your double A's, your single A's, they all kind of price out different. You get a higher return, the higher you go up on the risk, the risk ladder. That's one way to do it. It's passive investing. And you could be at a really low exposure point. But
I told him, I said, go buy fucking treasuries.
Yeah. And
that's what I would do. Fuck, I want no risk. If treasuries go bad, we're fucked anyway. You just burn your money.
Put it in a CD, at your bank or something.
Which is fucking craziness. Yeah. You've been listening to The Game of Loans, where real estate battles are fought and won. Make sure to fortify your defenses by subscribing. Cash flow is coming, and we'll be back next time to help you claim your throne. The war of wealth continues.